In this week's video, we'll review historical and present-day charts to help us understand why the I need income approach may produce extremely disappointing returns in the years ahead. This is a chart of 10-year Treasury yields, which is the de facto standard for interest rates. Calendar year 1980 on the left side of our screens, the present day, February 22nd, 2018, on the right side of our screen. As the chart shows, interest rates peaked in the early 1980s and for the most part have been in a secular downtrend since that time. Even if we don't follow the investment markets closely, we've probably heard at some point in our life that interest rates impact the value of bonds. So we can better understand the potential impact of rising interest rates, let's review some simple supply and demand examples. Let's assume that in 1981, we bought $100,000 worth of 10-year Treasury bonds. At that time, they were yielding somewhere in the neighborhood of 15%. And in this simple example, to illustrate basic concepts, let's assume that in the mid-1990s, somebody was still able to hold a bond that was paying 15% that bought it sometime in the past. If a new investor coming to market could only get 7% annually, someone that had bought a bond in the past and was still holding it was getting 15% annually, this investor here would much rather own this bond with a coupon of 15% relative to this bond here. So when interest rates fall in the secondary market in terms of supply and demand, falling interest rates puts upward and positive pressure on bond prices. Somebody would be willing to pay you more than $100,000 for these bonds paying 15% a year if new ones are only paying 7%. And again, in our simplified example, we're focusing on coupons here rather than maturities. If we fast forward to calendar year 2016, a new investor that wanted to place $100,000 in 10-year treasuries would have gotten a yield somewhere in the neighborhood of 1.5%, making anyone holding a bond paying 7% or 15%, these bonds look much, much more attractive relative to this yield here. So as interest rates are falling, there's upward pressure, there's an upward bias on bond prices, meaning if you own these bonds or bought bonds in this area here, as rates fall, the value of your bonds in the secondary market increase. So as interest rates fall, you're very, very happy if you own a bond like this or this. Now let's fast forward to roughly the present day. If a new investor coming to market can get 3%, they really wouldn't be interested in buying my bonds that I bought in 2016 that are paying 1.5%. So when interest rates are rising, it puts downward pressure on bond prices. And if I looked at my statement, which marks bonds to market, my $100,000 on my statement would be worth less today since the new bonds are at 3%. Nobody wants this bond if they can get this bond. And even though 3% is still quite a bit lower than 7 or 15%, it still starts to mute some of the upward pressure on these bonds, and they're going to fall in price as well. Therefore, if we look backwards from this point here in calendar year 2016, when interest rates made their lowest low, it's pretty easy to see that the bias over the past 35 years on this chart was for lower interest rates, telling us that anyone that was actively engaged in income-oriented investing, this is a very, very favorable period to own anything with a coupon or dividend. There was a major tailwind from the downward trend in interest rates. Since all good things come to an end, common sense tells us at some point in the future, which is to be determined, this secular downtrend will most likely flip over to a secular uptrend in interest rates, telling us that it's in the realm of possibility that the next 35 years might not look anything like the favorable period for income investing we saw in this 35-year period. In fact, the next 35 years may be very unfavorable. Instead of having a tailwind, income investors may have a headwind. And if interest rates continue to rise, that's really not an if, it's a fact. When interest rates rise, it puts downward pressure on income-paying instruments, telling us that rising interest rates negatively impact all dividend-paying and yield-oriented investments, not just treasury bonds. Anything that pays a dividend, including a blue-chip stock, has some bond-like characteristics and some interest rate sensitivity. And for our purposes and the model's purposes, we're not necessarily talking about gloom and doom here for bonds or income-oriented investors. We're simply saying on a relative basis versus growth stocks, instead of having that wonderful, nice, and comfortable tailwind on a relative basis, bonds could be facing a headwind relative to more growth-oriented investments. And that speaks to probabilities and opportunity costs. All things being equal, we would prefer to have a tailwind and not a headwind. And in this video, we'll show with actual historical examples how important that relative basis can be when we compare growth investments to income-oriented investments when perceptions change. We'll also show in this video that we have hard evidence that tells us in the present day, based on the facts that we have in front of us, we have an observable and measurable shift in investor conviction and confidence. And sometimes the perception, simply the perception that interest rates could move in this direction for a long period of time, has a significant impact on the relative performance of growth versus income. So the important point here is not that interest rates have to skyrocket. They probably won't skyrocket. They'll probably have a bias, an upward bias, but it's not going to be straight up. But once that perception shifts, it can have a substantial impact on relative returns, as we'll show in this video. This shift in perception that is taking place, we'll show hard evidence that it's taking place, we can measure it and see it, is very, very similar to the shift that takes place in the stock market when investors perceive that growth will pick up significantly. History tells us that these type of periods do see on the stock side improved earnings. But the bigger drive is the perception where we get multiple expansion and PEs expand. And often they expand in such a way that our historical reference point on the PE side is shattered in the future. We've demonstrated that in the past relative to where valuations were in 1982 on the stock side and where they were in the year 2000. The bias for some time now has been for PEs to be trending upward. It's also important to note here, in 2016, when interest rates make their lowest low at this point here, basically coincides with the bottom in the S&P 500. And common sense tells us that if 10-year yields were hovering around 15% in 1982, and at this point here, interest rates in some areas around the globe were below zero, it's very, very difficult to argue against the concept that interest rates, for the most part, from this point here, have nowhere to go but up. How fast they go up, how far they go up, is to be determined. We can't really argue the point that interest rates have nowhere to go but up when we're seeing negative interest rates in this area, which tells us that instead of swimming with the current as an income investor, it's not really if, it's just a question of when you're going to start swimming against the current. February 11th, 2016, right around the time the S&P 500 bottoms. Even Janet Yellen is saying it's possible we've considered negative rates. This point right here could represent the end of income investors swimming with the current in our lifetime. For the rest of our lifetime, or the next 5 to 20 years at least, income investors may be trying to swim against the current, and instead of having a tailwind, they could have a headwind, especially on a relative basis, and we'll show that with numbers. It's already happening. We all know that since the S&P 500 bottomed in February of 2016, the stock market has performed very, very well. Since this article was written, and this concept should be good for bonds, but that's the lowest point. Since then, sentiment has shifted, and TLT, while the stock market has done extremely well, has lost 8% of its value, and that includes dividends, since February 11th, 2016. So we're not talking about something that might happen. It's already happening. Stocks have significantly outperformed bonds since we were reading things about negative interest rates in 2016. It's also important to note, if you currently have an income-producing portfolio, what the psychology may be like in the days, weeks, months, and years ahead. It's very, very similar to the psychology of a bear market in stocks. Let's assume this orange line is the S&P 500. At the end of a bear market, people look back and they say, how did I lose 50%? How did I let that happen? Markets are cruel. I'm worried about my stocks, I'm worried about my stocks. Oh, everything's fine. See, I made the right move. I should have held. I'm worried. Oh, see, I'm fine. I made the right move holding. Oh boy, this is bad. I feel bad. Oh, this is really bad. Oh, see, my patience is paying off. Everything's good. That happens all the way down until you lose 50%. The market makes it very, very difficult. This is a downward trend. These are normal counter trend rallies, which basically says if you're long stocks, and this is the S&P 500, you feel bad, you feel good, you feel bad, you feel good, you feel bad, you feel good. You feel really bad down here. The same thing could happen with interest rates. When this trend flips, and that's to be determined, we're not calling any turn in interest rates. We're just basically saying the odds say at some point when we're talking about negative interest rates down here that this trend, secular trend, is going to turn. And the same thing will happen here. I'm worried about my bonds. I'm worried about my bonds. I'm worried about my bonds. See, I made the right move. They're coming back. See, I made the right move. Oh no, here we go again. My bonds are falling. My bonds are falling. See, I made the right move. Patience pays off. And that's how people will look back a year, 3 years, 5 years, 8 years, 10 years down the road and say, how did I let my bonds lose that much in principal? Especially if you have bond funds. At least if you're holding individual bonds, you can hold them to maturity and eventually you'll get all of your principal back. But that's not true in a lot of instruments that we'll cover this week. And even if you own individual bonds, it doesn't mean it's going to be easy to hold them. Just like it's not easy to hold a buy and hold stock portfolio when the S&P 500 drops 50%. Even if you're able to hold your bonds till maturity on this side of the chart, there's going to be a great emotional toll between point A and point B potentially when your balance is swinging all over the place. Before we get into specific examples, let's set the stage. Other than that interest rate chart, do we have anything else that tells us the perceptions of stocks relative to bonds have already changed, as we covered in last week's video? And we'll show you how to find that video. The answer is absolutely, positively yes. This long-term bullish breakout in favor of stocks relative to bonds tells us that the odds have improved greatly, that that interest rate chart is in the process of flipping. And here's your point right here. And this breakout here increases the probability that this is the end of an era where income-producing investors have been swimming with the current and they could be swimming against it, especially relative to stocks, for a long, long time. Not a prediction. It's a probabilistic statement based on the facts in front of us. We can see this, measure it, and put it in a model, just as we could see, measure, and put in a model the breakout that occurred in 1994. The longer a market goes sideways, the bigger the move we can expect to get. In this case, from this point in 1994, which is very, very similar to this point here, stocks and growth-oriented investments crushed income-producing investments. And again, we'll show firm, hard examples using real investments. And as we noted last week, this consolidation period is quite a bit shorter than this consolidation period, telling us that bonds and income-producing investments could underperform for a lot longer than 6 years based on how long we went sideways in this breakout here. Last week, we also covered the psychology behind this pattern. It also aligns 100% with stocks outperforming bonds in the months and years ahead. Will this line go straight up? Absolutely, positively, no. There will be 100% normal and to be expected counter trend moves within the context of an ongoing bullish trend, even if it all plays out this way. So there will be periods where bondholders feel good and stockholders feel bad. But the bias and the actual balances will favor, most likely, based on what we have in front of us today, growth over income. Last week, we also showed, and we won't go over it again, present day looks very, very similar to this signal here in 1993 that told us to be open to stocks significantly outperforming bonds in the years ahead. The present day signal is quite a bit more convincing than this signal that proved to be very, very valuable. The other example we showed last week, value line geometric index, went absolutely positively nowhere between 1998 and 2017, and we have a bullish breakout for stocks telling us we have a change in perception relative to expectations about the economy and earnings growth in the future, as well as interest rates. In this chart here and the interest rate chart both tell us that this shift could last a long, long time in favor of stocks relative to income, just as the signals that we covered in last week's video tell us that the stock market could surprise on the upside for a long, long time, and that the present day really doesn't look anything like, not even remotely close to a major top in stocks. So the probabilities do not favor, right now, a major top in stocks that's going to bail out income investors. To the contrary, the evidence that we have in front of us tells us that the relative pain for income versus growth could last a long, long time. Somewhere on the order of 3 to 20 years is not unreasonable based on market history, not a prediction, simply making probabilistic statements based on the facts in front of us. If the facts change, then the probabilistic statements will have to be adjusted. That's where maximum flexibility comes in. If you want to gain a better understanding of the charts that we just covered, you can Google this title here, and you should be able to find a video describing those charts in detail on our blog, Short Takes. One of the things that we find frustrating in the financial markets is we hear a lot of theory. We very rarely get hard evidence that shows us something that we can use to take action. So earlier we said this point here in 1994 looks very, very similar to this point here. The only difference is this is a much more convincing case for a long-term move in this direction than this was. This is a more powerful signal. What happened to income-producing investments or an income-producing portfolio between roughly 1994 and the year 2000? That's a 6-year period. That's a long, long time. If you're 55 years old, that means you could be in pain with an income-producing portfolio till you're 61. We also said that this signal here in 1993 is similar to the present day. Once again, telling us we have evidence from multiple sources, including a long-term breakout in the NASDAQ, a long-term breakout in the Dow, and a long-term breakout in the S&P 500, saying that the next few years will most likely look more like this than what we've seen looking backwards for a long, long time. Interest rates, for the most part, have nowhere to go but up. What happened the last time we had a similar breakout in the 90s? Here's the point right here where the hard evidence told us that the probabilities had most likely shifted. In 1994, this is where the stock-bond ratio broke out, what we just covered. You can see after that point, Southern Company, an income-producing, quote-unquote, conservative and safe utility, significantly underperformed the S&P 500. This is where ADX told us in 1993, we had hard evidence in hand. We weren't forecasting anything in 1993. We were simply looking at hard evidence and assessing probabilities. The probabilities in 1993 said, you're much better off. You'll be swimming with the current in growth-oriented investments, and you will most likely be swimming against the current in income-producing investments. American Electric Power, very, very disappointing performance relative to growth. Master limited partnerships can be very, very appealing because they have that wonderful dividend. But unfortunately, their share price can also go down. Same story with an MLP. And if you want a more diversified look, from 1996, when this index was created, to 2000, an index of master limited partnerships significantly underperformed the S&P 500. In this case, the Vanguard Index 500 Mutual Fund. Preferred stocks have bond-like characteristics because they kick off yield or dividends. Similar situation. This is a preferred stock income fund, hammered relative to the S&P 500. You're swimming against the current in income investments here. Another preferred fund, similar situation, expending a lot of energy, not taking the path of least resistance in income here. How about large cap blue chip dividend payers? This is a mutual fund here. Similar situation. It doesn't mean it didn't make money. It just means it significantly underperformed. If you're into balanced funds or been on Wall Street for a while, you've surely heard of the Dodge & Cox Balanced Fund. Balanced funds, basically a split between stocks and bonds, significantly underperformed. This is relative performance. But again, you're swimming against the current, trying to force something that market conditions are saying that's not a good place to be. REITs are high-yielding instruments. They can be very, very popular in income portfolios. Similar situation, an ugly chart from 1994 into 2000. A second REIT for illustrative purposes, ugly. To give us a fair apples-to-apples comparison to the present day, since many of these signals that we have in hand today occurred in the rear view mirror, let's take a look at how an income-generating portfolio, a diversified portfolio, performed from the end of 1995 until the stock market peaked, the S&P 500 peaked, in March of 2000. The title of the video used the term disappointing. If you know your stock market history, anybody that lost money between the end of 1995 and the spring of 2000 would most likely have been disappointed. Why? Because the S&P 500, or SPY, with dividends reinvested, gained 164% over this same period. A diversified portfolio with a balanced fund, a growth and income fund, REITs, preferred stocks, master limited partnerships, and defensive utilities lost 1.54%. Therefore, if my mindset at the end of 1995 was, I need income, my $2 million would have turned into 1.9 million 4.23 years later because I was trying to swim upstream. If my mindset was broader, thinking I need to protect and grow my assets, my gain could have been much more satisfying. Simply using the S&P 500 to illustrate relative performance, 1.9 million versus 5.2 million. Therefore, let's talk about the broader mindset with your retirement funds or your nest egg. Our investment return, or our total return, which is what we really care about, is the sum of our income and dividends and hopefully our capital appreciation. This is where our share prices move from point A to point B and we make money. In the world of investing, total return is always what counts. It doesn't do us much good to produce a portfolio that kicks off a 6% dividend if our share prices fall and our total return at the end of the year is negative. So in the present day, if our mindset is exclusively, I need income, or if our mindset was exclusively, I need income heading into calendar year 1996, I wouldn't have been thinking about total return, and I really wouldn't have been thinking about growth relative to income. It should be an opportunity cost. If I'm only considering income, I never ask the question, is this a rational place to be? And how does this compare to this? And as a result, when we don't look at all of our options, we may end up swimming against the current for long periods of time, which means instead of having the odds in our favor, they're automatically stacked against us. And as we've shown, it's very, very possible that that type of mindset might be swimming against the current for a long period of time. Even if interest rates don't go up very much, the fact that perceptions have changed and the fact that the relative performance has flipped and broken out is really why you're swimming against the current. If you've been investing in income, for the most part, for our whole adult lives, we've been swimming with the current, and it's been easy. Everything we know about income investing, dividends, utilities, blue chips, preferred stocks, master limited partnerships, U.S. Treasury bonds, high yield bonds, you name it, anything that kicks off yield or a coupon, everything we know might be changing. Income, tailwind, income, possibly a headwind now for many, many years. Not a prediction, simply a probabilistic statement based on the facts that we have in front of us. The breakouts that we've seen and the charts that we looked at, they're indisputable. We can't debate these facts. That's what the odds tell us today. Is it possible that the breakouts fail? Absolutely, positively, yes. And then we would adjust the probabilities, and if need be, in our case, we would adjust our allocations. But this is real here, just as this was real here. We could see this, measure it, and put it in a model before that income portfolio greatly underperformed in an extremely disappointing manner. This period here looks very, very similar to this period here. The only difference is this signal is more convincing for stocks relative to bonds than this signal was here. This signal is more convincing than this signal was here. So the moral of the story is we should always be thinking about total return and saying, would we prefer to be overweighted in income and dividend producing investments, or would we prefer to be overweighted in growth? Or in some cases, based on the facts in front of us, it makes sense to do roughly a 50-50 split. That's quite a bit different than entering and waking up every day in this area here. In the present day, the facts that we have in front of us, if we want to swim with the current, our bias should be heavily towards growth relative to income. That's not always the case. Our model compares the two And we're very, very happy to shift the allocation back this way, including going to 100% bonds or even 100% cash, if that's what the facts tell us to do from a probability perspective. Broad options are always better from a probability perspective than a narrow list of options. And we narrow our options when we get stuck in the I need income box. We can't force an income portfolio into an environment that's not favorable for income. So we have to adjust and think about total return in all of our options. And since we're covering a topic we don't cover very often, income and dividends, it's possible you might be new to these videos. We've been covering, dating all the way back to August of 2016, a mountain of observable evidence that helped us assess the probabilities over the past year and a half or so. And all of it, and you can review it, you can find all of this on the Shivako Capital YouTube channel. All of it aligns with everything we've covered in this video. It's not just a handful of charts. And it's not just charts, it's demographics. We've covered demographics also support this hypothesis that growth is a much better place to be right now based on the facts in hand relative to income. You can find this video that was published in September of 2017 by Googling this title here, or you can find it by Googling this title here. It's also in this January 31st, 2018 Short Takes post. If you're new to these videos, a fair question may be, can hard evidence and the concepts that you've covered help us when the inevitable bear market finally arrives for stocks and for SPY? The answer is absolutely positively yes. The observable evidence can help us assess probabilities. The probability of good things happening relative to the probability of bad things happening. We always think about both sides of the coin. Clients and regular viewers know these charts show the simple 100-day all the way out to the 290-day generic and for illustrative purposes only moving averages. Can't emphasize that enough. The moving averages that we show in these videos are not the moving averages used by the model. We simply show them in the videos to illustrate basic concepts. If we look at this point here, does this look discernibly different than this? The answer is yes. Does this look discernibly different than this? Yes. Here, blue, the fastest moving average is on the bottom, and here it's clearly on top. The slopes are all up. This is what a bearish bias looks like. Price below our moving averages, the slopes are down. Price below, slopes are down. After we could see this different look here, the S&P 500 lost an additional 46%. We didn't have to forecast or predict anything. The S&P 500 from this point here lost an additional 56%. We didn't have to forecast or predict anything. And back in 2017, these charts helped us stay invested during normal and 100% to be expected volatility. And the charts can help us with the normal, what about Fed policy, what about valuations, what about interest rates, inflation, etc. The market is thinking about everything. Interest rates, Fed policy, valuations, the VIX, North Korea, you name it, it's been thought of, and it's reflected in these charts. The charts cannot predict the future. They just help us assess probabilities. Back in September of 2017, we said this really doesn't look anything like this, and this really doesn't look anything like this. In the present day, why have we kept either 100% exposure to growth investments during the recent pullback, or in some cases, we did sell roughly 3%, so why did we keep 97%, depending upon how long the client has been with us? Why did we treat the recent volatility, for the most part, as volatility to ignore? Because this is what the same exact moving averages look like on February 23rd, 2018 at 10 a.m. The present day still looks like a favorable period, like this period in 1996, and we've been talking about 1996 stocks relative to bonds in this video. The present-day stock market looks a lot like this point right here, and after that, really good things happened in the S&P 500 for over 4 years. And we also know that the present day really doesn't look anything like this concerning period here or this concerning period here. And as we've been stating in these videos for some time, in a secular trend, a secular bullish trend like we have today, our goal is to navigate between a point A and a point B that could be several years down the road. This is a chart of the NASDAQ, which gained 376% from point A to point B. And we know, just like the pullback that we've had, we're going to have 100% normal and to be expected volatility between a point A and point B. The model helps us discern between volatility to ignore within the context of an ongoing and already established bullish trend, and eventually what will morph into at some point in the future to volatility to respect. When will that happen? We have absolutely, positively no idea. We will continue to take it day by day and simply ask, are we allocated properly today on February 23rd, 2018, based on the evidence in hand? If the answer is yes or we're not sure, leave it alone and give the long-term bullish trend, the primary trend, the benefit of the doubt. Eventually, the answer will be no, and we'll start to make incremental adjustments. Experience says if we get too hung up on trying to predict when that will happen, we're going to expend an incredible amount of a limited resource, two limited resources, emotional and mental capital. Under our approach, it's better to take it day by day. Wake up every day and say, I believe that I can continue to ask those questions today, tomorrow, 3 months from now, and 3 years from now. But the only way that we can do it is if we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.